What's up, everybody? Happy Friday. It's that time of the week. It's time for the Security Token Show, everyone. That means we've got the latest and greatest tokenization of RWA's real-world assets here for you this week. We've got some amazing interviews, more guest contributors this week for the market movements, and a whole lot of topics to cover, Kyle. So, wow, we got a lot to get into, but how are you, my friend?
What's up, Herwig? I am psyched to be here. We are only a couple weeks away from Tokenize This, so getting excited to be out in New York City for the event. And other than that, man, ready to dive into a jam-packed show.
Cannot wait for Tokenize This, but cannot wait at all for the show right now. So let's get going.
Welcome back to Security Token Show Interviews. This week, we have a special guest, Simon Keefe from Calastone. Simon, how are you today?
Hey, Jason. Fantastic. Thank you. Great to be with you.
Absolutely. Thanks for coming on. You guys had a very exciting announcement this morning being Thursday, April 3rd, that we're recording this here. And that's that you guys are officially launching your Calastone Tokenized Distribution platform here. So tell us a little bit about this announcement and what really this is and the impact you think it'll have for funds here.
Yeah, absolutely. Thank you. We believe this is a landmark announcement. It's been a long time in the works, working with the team here at Calastone, but with a number of clients, big asset managers around the world to bring this to fruition. So really exciting times that we've got the products out there and live. And essentially what we're doing is making it really easy for asset managers in the traditional space to launch products into the DeFi world. To cut through the red tape and kind of weeks and months of integration and different pilots that they have to do, to make it simple to use their existing connectivity that they use for distribution in the traditional world today, extend that out to enable asset managers to reach new DeFi venues via basically any public or even private blockchain that they require.
That's really cool. And I love that you guys are doing both public and permissioned chains here. I know that, I think I saw Polygon, I think I saw Canton in there, a few others, right? So that's fantastic. But let's stick a little bit on topic of distribution that you just touched on here, because I think it's really important. The tokenization space obviously is somewhat fragmented, and to have someone like you guys that are already kind of plugged into legacy systems, it works well, right? So if I'm understanding this correctly, if I'm an audience member here to understand this announcement, essentially what you're doing is you have fund asset managers, right? The funds that if they want to tokenize some of that fund to be able to distribute on chain, they can, and it all connects back to the legacy systems for appropriate transfer agency and all of that. Is that correct?
That's exactly it. We've been working with a number of asset managers around the world for the last 2 years to really solve that issue. So to link up the traditional world with the DeFi space. Many have tried it and have kind of experienced proof of concepts where they've done one-for-one connectivity to a certain chain and certain addresses on those chains. But what we wanted to do with clients was to make it kind of scalable for the future, and importantly, enable them to do it in a place that they're comfortable acting now. So they don't have to have enormous change on the back end. They don't have to change the traditional fund that sits there, at least initially. That they can simply get those products out to reach new investors on a multitude of different chains, but do it at a cost that makes sense. So, to attract new investors at a cost that is much more in adherence to the existing costs in the asset management industry, and not to put kind of layers on top of the existing costs just because you're distributing it on chain. And that's been one of the big drivers.
That makes total sense to me. And I do want to dive a little bit deeper into the costs in a second. But as you're kind of exploring this and whatnot, what would you say is the biggest challenge that you guys had to arise when you were putting this together? Because as you mentioned, many have tried it and whatnot. So what's different for you guys, and what was the biggest hurdle when you were exploring, again, this distribution and legacy system connectivity?
Yeah, so I guess the main USP of the Calastone product and product set and proposition is exactly that. It's the heavy lifting that asset managers and their partners kind of have to suffer today to get a fund on chain. You can do it once, but then pretty quickly, if you're in the DeFi space and you want to connect into the TradFi space, you pretty quickly realize that integrating into the traditional world isn't that easy. It can be pretty complex. There's a multitude of different connectivities needed and different parties and players. But what we bring to the table with our asset managers is our network. So we have a network of 4,500 asset managers and traditional distribution venues. We've done all of the hard work, all of the connectivity into the traditional rails. That's already there. So the challenges that distribution venues on chain face is having to interface into that world. But we already do that for our network. So the challenges we had were the opposite. It was trying to take the traditional world and apply it into the DeFi space. But no, we are a technology company, despite just being a network. And we've managed to get over a few hurdles, regulatory hurdles, uncertainty, definitely. Nervousness from asset managers was a big hurdle. Can they do it? They want to do it. Can they do it? Where is the money? Who's going to buy the funds was a big piece. But we're starting to see more demand, certainly coming through our networks, and our asset managers, importantly, are seeing more demand coming directly into them to start to buy into tokenized funds. So now we've got an end-to-end model that works, is scalable, connects into any of our asset managers, but on the other side connects into any chain.
Makes sense, right? And scalability is the name of the game here, obviously, and of course, and no one can say no to cost savings and making things a little easier, right? So I know this comes also in connection, essentially, to a report you guys just launched, maybe like a month ago, if that, talking about cost savings in tokenized funds. You have a whole white paper research that you guys put out there, which I found very interesting. But one of the things that you guys found was that there's $135 billion per year worth of cost savings that we could be extracting here by putting funds on chain. Tell us a little bit about what you're seeing in terms of, operating costs and, this image here, and what you're expecting tokenization to really have the most impact on.
Sure. So the distribution piece that we've been speaking about is just really the tip of the iceberg. Now that's where everybody's looking at the moment and where the kind of early wins are. And there is, a great opportunity there for asset managers, because ultimately asset managers want to see new monies coming into their funds. But when you kind of peel back the layers of the onion, in the traditional world, there's a lot of complexity. There's a lot of complexity that's grown over 100 years or so of a mutual fund that's just been added and added and added as the fund has evolved. And nobody's really taken a step back to look at that construct of a mutual fund or any collective investment from an asset manager, look at the technology that's available now and try to see the efficiencies that we can bring. If you redesign the mutual fund model today from scratch, you certainly wouldn't design it as it is and has been working in the marketplace. So we've been working with a number of our clients, again, globally, to look at the application of tokenization, DLT, and technology just in general, to look at what that could mean throughout the whole construct of a mutual fund and an asset management product. So we're talking kind of more the back end. So reimagining the middle office, back office of a fund. How do you construct funds? How do you service funds? Importantly, do you need multiple siloed parties all working on a different data set and having to bring those data sets together at certain points during the day or the week or the month to make sure that everything is interacting as it should be? It's really complex. So we undertook a piece of work, an initial kind of pilot, working with Schroders in Singapore to look what it would take to get everything on chain. And we were very successful. We did that. And we started to realize that the efficiencies are huge. And the figures that you mentioned, 135 billion, that we feel that, well, not we feel, actually asset managers that we surveyed confirmed to us that they see being up for grabs just by bringing tokenization into the issuance and servicing area of mutual funds. Personally, I think it's a lot bigger. It's a lot higher than 135 billion.
Very well.
It really is.
Right, and this takes into account, obviously, funds across different jurisdictions and different asset classes and whatnot, which I do want to dive into a bit more. I'm going to pause here, though, for anyone that's watching on the Security Token Show. We will be moving on to the next section of the show, but if you want to watch the rest of this interview, it is going to be on STM TV Official on YouTube. So go ahead and check it out there. But we're going to keep on diving into some of these cost savings and really what Calastone is powering here.
All right, Kyle. I bet everybody's pretty surprised right now to see 6 faces up here. 4 fresh faces, 1 recurring, actually 2 recurring guests on the show. Nico, of course, out of Dubai. Glad to have you back. Yuval, of course, co-founder, CEO of Digital Asset. And Phillip Falcone and Sharon from DigiX, who had some pretty big news we're going to get into today. Welcome to the show, everybody.
Hey, good morning.
Thank you.
Hi, guys.
Happy Friday. We've got some pretty big news. Why don't we just kick it off straight with this big announcement from T0 and DigiX? Phillip, Sharon, who wants to deliver the news?
Yeah, I'll start. Well, I mean, it is something that we're pretty excited about. We like the dynamics of what T0 is doing, what they have the capabilities of doing here in the U.S. And I think they looked at us as an appendage of some sorts where we can really provide some value with what we're doing offshore and our focus on retail. So I think the combination is going to work out quite well. We have a tremendous amount of deal flow, which is one of the key things that we really bring to the table. And also the focus on the retail investor. We've always, when we started this concept, we've always looked at kind of the democratization of investing and giving the individuals across the globe an opportunity to really participate in assets, very high quality assets here in the U.S. There's not many times that people overseas can get involved in a pre-IPO situation. So I think that's one of the things that we're really focused on is finding high quality assets and bringing them to the platform. And I believe T0 kind of looked at it as a very good complement to what they're doing over here. So we're very excited about that combination.
Anything you can tease about timelines of what we might expect to see soon?
We're working on a number of interesting deals. I think people will be quite surprised, quite frankly. One of the dynamics is, I think that makes us a bit different, as I come from an asset management background. You guys were asking earlier from a finance perspective. I mean, I've been doing this for 30 plus years, and we were talking about how some people think Armageddon, how some people think what happened over the last couple of days was Armageddon. Between 2008 and 1987, where I first started, a lot different dynamic than over the past couple of days, which I think is a ho-hum. So I think that's one of the things that we bring to the table that is kind of unique in the space. Our deal flow, and of course, Sharon's know-how and experience in the blockchain space. I think that this combination is kind of intriguing, and we've got some really interesting assets and interesting structures, because my background is really financial engineering and of course asset management. So we're trying to bring that to the stage and really bridge that gap that I don't think we've seen before. So we're pretty excited about it, and I think you're going to see some good things from us over the next few months.
That's amazing. Anything from the rest of the crowd here? Any questions for Phillip or Sharon?
I want to say first, congratulations, teaming up with one of the 3 major players, I guess, in the US at the moment. So that's good news. Always happy to see getting more product to the public is a good thing, especially on these new blockchains. We have to get more liquidity into these new railways, and getting first product online is of course a necessity to get there. Phillip, what what I see is that we original TradFi guys, me coming from Europe, the European financial system, is that we are now hooking on to these new these digital ecosystems, because we see the new financial system getting shaped up in these blockchains. So that's great for me to see the older generation with the newer teams.
Yeah. I mean, I'm a huge believer in it, and I think it is going to really explode over the next 3 to 5 years. As I was telling people, the average 25-year-old overseas is not focused on IBM stock. Just not doing it. That whole dynamic of trying to get involved in the stock market, I think, it's obviously not going away, of course, but there's a whole big marketplace out there that hasn't been tapped. And I think, security tokenization is on the, cusp of really tapping that marketplace. So I think it's nothing but poised for major growth. And, as you said, T0 was we're very excited about getting involved in them and, utilizing their experience. They are one of the big three over here. So we're pretty excited about that, and, going to leverage off of their expertise and their know-how, and I'm sure we'll be able to complement some of the different things that they're doing as well. But
Phillip, I have a question for you as well. I think that we've talked a lot on the show about how it seems like there's a trend in the investing world around investing in fund products or passively kind of managed investment vehicles as opposed to individual assets, whether that's in the stock markets. We're seeing ETFs and mutual funds grow in their size. Even in the private markets with LPs, you see so much private credit these days where you're essentially just kind of giving this money in the form of debt to somebody else to manage and give you a return. Are you seeing a similar trend, and is that driving some of the demand for fund products in particular, or do you think is there a different reason why this type of vehicle is one that you find particularly attractive?
Well, I think the opportunity is there. I mean, you're seeing some of the institutional entities get involved in it, but I do think there is a massive opportunity, especially on the private side. And that's one of the reasons, and one of the reasons I first got involved in this, other than, Sharon kind of saying, this is, kind of beating me over the head, saying, this is right up your alley, you should be focused on this. That you mentioned the private space, the private credit space. I mean, I don't know how many guys that I know that are have investments in hedge funds and private equity funds, and they want to sell them, they can't get out. And because of the limited partnership structures, makes it super complicated to get anything done. So while I don't think anybody has crack that code yet, I think that is on the cusp of something that you will see happen in the tokenization space, just from a liquidity perspective. To be able to go and participate in a private fund where you don't have to put in $500,000 or $1 million. But at the same time, if you're an existing investor and, things change, what you invested in yesterday may not fit your parameters tomorrow, and try to get out of one of these hedge funds or private equity funds if you're an LP. It's not impossible, but it's close. So I think that, there's a massive opportunity there. And that's one of the things that we've been very focused on. And one of the reasons why, when I first started in this, kind of got me very interested, because specifically because of the liquidity factor and providing my particular limited partners with potential liquidity so they could move out of things after being an investor for 10 years. So I think that's one of the dynamics of when you talk about the fund market that we're very focused on, where we think there's a huge opportunity.
Yeah, I think you bring up the fact that you can lower, ticket minimums, but also the magic word of liquidity keeps coming up and up and up. And I actually like to toss it over to Yuval. We just saw Flowdesk join the Canton Network, and maybe you can give a quick primer on the Canton Network for anyone watching, listening doesn't know. But let's talk about liquidity a little bit, and maybe how either Flowdesk or in general how you guys are tackling this, because obviously Canton Network is doing something pretty awesome on the financial institution side of things.
Yeah, sure. I mean, so real quick, Canton, we believe, is the only layer one with privacy capability out there today. So public layer one that can do applications with privacy on it. And as a result of that, our focus is on institutional assets, but then that have, even retail facing applications. So maybe just kind of continuing on the previous topic, I agree on the points around private credit. We're doing actually quite a lot around private credits and even the fund space. I think by the end of this year, we will have over $200 billion of private equity funds on Canton, in partnership with a company called iCapital, which are effectively moving all of their feeder funds to Canton. And I think for us, the first part of tokenization is to actually reduce. You mentioned earlier ticket size. I think ticket size is also associated with the operational cost that is associated with transacting on that fund and managing the back office, middle office associated. And I think that when you create new funds, as Phillip described, I think you have a great opportunity to do that. The reality is we have 100,000 funds out there today with trillions of dollars of assets that do not have that benefit. So where we're focusing on tokenization is how do we actually bring existing assets into this world of DLT to actually change the performance of existing funds. So we believe that there is a massive opportunity. iCapital alone manages 1,500 funds, just to give a sense. So that's where we're starting. And maybe I want to tackle Philip's point, because I think it's a really good point that alternative investments today lack liquidity, but I would actually also think about liquidity in a slightly different manner. That liquidity doesn't only involve being able to sell your asset, but it's also having a utility associated with that asset. And what I mean by that is, imagine you go to your bank today and you say, I have $1 million private credit fund at Carlyle, right? It's a private credit fund. It pays me $10,000 a month of income. And I want to now take a $500,000 loan and I want to use that holding as collateral. No chance you'll be able to do that today. I mean, unless you're like an ultra high net worth individual and the bank is doing you a favor, like you're not going to get that. So I actually think that one way also to think about, some of the opportunity that Phillip and us are tackling is that liquidity doesn't always have to come in the form of selling your holding, but the ability actually to pledge assets as collateral against a loan. And then you could think about, well, we have massive amount of yield-bearing assets that could easily be used as eligible collateral for, collateralized loans. And I think that's a big opportunity that we're tackling. And I think that if you have these assets natively on chain, it's very easy to encumber the asset and then kind of pledge it against a secured loan that you take. And I think that that's a great way for, Phillip LPs to get liquidity from having like this long-term holding without creating this taxable event of actually having to sell their holding. So I totally agree with the opportunity. I just think that, the breadth of liquidity opportunities is big. And for the most part, we hear a lot of people talking about secondary trading. So that's just one. With respect to the announcement, I mean, today, we are adding more and more liquidity providers to Canton. We wanted Canton to be a top 10 chain from a utility before it ever gets listed. So all of the liquidity currently in Canton is over the counter. We will list later this year. We're in advanced conversations with a few listing venues. But again, for us, it was really important that the day we list a token, Canton is already at like a top 10 utility chain. So that's why you're seeing these announcements of these liquidity providers joining the network.
I love to see it. I got to say, I love to see it. Also, my jaw dropped when you said that, with iCapital, you're bringing 200 billion onto Canton. So I want to bring this up because PwC just came out with a report, and I kind of like making fun of these, kind of big consulting side or big four type, predictions. But their prediction is by 2028, 317 billion of tokenized investment products will exist. So it looks like you're gonna have more than half the market, Yuval.
Well, I think, yeah. Listen, I generally speaking, I agree with you on these reports. But again, this is why I wanted to put in perspective of we need to also explain what do we mean by tokenize, right? And not all tokenization is created equal. Are we bringing existing assets? Is it new assets that are going to be created? I don't believe that report if we're talking about $300 billion of brand new funds that are just going to come through tokenization. I think we are very much focused. You mentioned earlier Collateral. Like if we're just going to keep on waiting for new digital assets to be issued, I think this technology will never show its value. So we are actually trying to tackle the world of existing assets. And can you actually immobilize them in the old world and just create a true legal representation of these assets in the new world? And then if you think about that, we have trillions upon trillions. I mean, there's over $40 trillion of US treasuries, right? Like there's, Euro bonds and gilts in the north of $20 trillion of assets. So we are doing a lot of legal analysis and a lot of legal work to make sure that we can actually take existing assets and onboard them into a public L1 and have that now be the legal title of those assets, because then the opportunity is really big.
That's awesome. Anyone else have any comments on the report, this prediction?
Yeah, I think it's interesting. I had a question regarding kind of some of your perspectives, Yuval, around, I like what you were talking about with respect to having utility tokens and things like that, onboarding crypto market makers. Do you think a lot of those types of business models with respect to leveraging crypto and digital assets still can apply into the real world asset industry? I know that there's different regulations around market making, for example, in securities versus utilities. Do you have the buy-in from these types of crypto market makers and liquidity providers to also facilitate into the RWA asset class? Or is that going to be a kind of a whole different vertical for your team with a whole different vendors and things like that?
I'll make a very strong statement. I think that if you are not going to make liquidity on those things, I think that 99% of crypto goes away. If you put Bitcoin as a unique asset class, all of the smart contract chains are all effectively app platforms. And at the end of the day, eventually people will steer towards things that create real world utility, like Philip's products. I mean, at the end of the day, you are looking for the liquidity. So you could look at Bitcoin as a store of value, great. Park that aside. Everything else, all the smart contract chains are really just platforms to bring assets that generate utility, right? I mean, even when you look at crypto today, I mean, in DeFi, it's all about, hey, how do I stake my asset to get some, yield against it? So at the end of the day, the reality is we're going to move into tokenization being kind of the other killer use case alongside Bitcoin. And you're going to have to make markets on those assets. Now, the reality is when you look at who are the largest crypto market makers out there today, now Citadel Securities is coming in. You have Jump, you have DRW Trading, you have Jane Street, Optiver, CMT. I mean, I can keep on going, right? And yes, you have FalconX, and yes, you have Arbalest, which, right, like, or Wintermute, and Arbalest was acquired by FalconX. Like, at the end of the day, if you look at the initial list that I had, these are all real-world asset market makers. I mean, Jane Street and Citadel are probably some of the largest fixed income market makers in the world, right? So I think for them, there is no transition, Kyle. I mean, they are already doing that. If you're going to show that tokenized assets like what Phillip is doing, what us are doing, like those type of things, have enough depth and volume, for them, it's just going to be like, okay, this is just what we do for a living. I mean, it's not going to be a transition. So I just, generally speaking, believe that RWA is the only interesting opportunity outside of Bitcoin.
I think that's a fascinating perspective. I want to keep the conversation going, but I have one follow-up there, which is just that I have heard from different market makers in the past, and I love your perspective. I totally agree with what you've described. One of the pushbacks I've heard before is that the derivatives market isn't developed enough to actually hedge properly as a market maker in the RWA space. Do you think that that's a kind of a cop-out answer, or is that something that you think that we could see coming to provide short exposure in the event that a market maker wants to actually hedge their investment, as opposed to taking direct exposure to the underlying asset, which may be illiquid?
I don't agree with that, because you could use that example across the board, even outside of crypto. Now, having derivatives and liquid markets means tighter spreads. It doesn't mean that you can't make markets, right? So you do have people making markets on super small cap securities today. They are making markets on them. Now, do you get the spreads and depth of book as you would get an SPY? Nope, you won't. But there are people that can make markets on those things. It's just, right? I mean, at the end of the day, market making is selling insurance, right? The bid-ask spread is your insurance premium. Sorry, I need to say, I used to be a market maker. So, I mean, when you think about
this is great. No, I appreciate this, because we've never had expertise on market making.
Yeah. So the bid-ask spread is your insurance premium. And if there's a lot of liquidity and there's the hedging, as Kyle, as you just brought up, well, it's very easy for you to unwind the risk. And therefore, the insurance premium that you collect is very small, right? That's really all it is. So when you hear, what you just said from market makers, they're saying that, yes, selling insurance when there's not a lot of easy way to unwind the risk is hard. That doesn't mean that there are no people that know how to underwrite, risky assets. That's
totally agree with that. Yeah, 100%.
Yuval,
and as Phillip and myself develop these markets and add more and more utility, you're going to see what happens with markets. Certain assets will have tendency to have more liquidity associated with them, and therefore you'll see the spreads and the depth of book become bigger and the spread becomes smaller, right? And then there's going to be assets that naturally do not have liquidity associated with them because of the characteristics of the asset, whether it's real estate and others. And therefore, you will have market makers. You will have people that are willing to underwrite the risk. You're just not going to have a depth of book or, a very tight spread, because they are hard. They're taking on more risk than usual.
I'd like to add something on that. You think of how the financial markets have evolved over the last 30 years. The derivatives market has exploded from where it was in the late 80s and early 90s. I mean, now it's a massive marketplace. So I think it's just a matter of time. And as you've all mentioned, that creative people will figure out a way to get it done. And, that market will continue to expand. I mean, today you may not see it, but tomorrow I can almost assure you it will be there. It's just a matter of time. And the more people that get involved, there's a lot of creative people, and it'll happen. And, I think you're going to see that market change dramatically over the next 2, 3, 4 years. I mean, that's an opportunity in and of itself, from a derivatives perspective.
The big opportunity.
Yeah.
I have one more question for Yuval, since he's involved in market making. Aren't these guys also waiting for the right regulation, especially in the US currently, or is that not what this guy is holding back currently?
Oh.
Because you mentioned we have to first get these deeper pools or involvement in these certain markets, in these RWA markets. I'm always hearing that regulation is also what's keeping them. Yeah.
Oh, listen, the iCapital project is in the U.S. Broadridge have tokenized over $2 trillion of U.S. treasuries and are doing about $100 billion of repo every day, and they're heavily regulated. I think that it's a question of how do you approach tokenization and what are you trying to do. I've always had the view that regulation, if you build technology where regulation is a hinder, you're not building the right technology. I've personally haven't ran into a regulation issue. Now, that being said, Nico, I think that there has been concern by clients of even potentially being associated with the technology, which is not necessarily, I think we've had a lot of conversations where potential clients said, we agree with you. We think that what you're doing and how you're proposing to do it has no regulatory issues. That being said, I'm just telling you, if you go to said regulator and they hear the word blockchain, they don't really care. They're going to like come down on you hard. So I think that there is, so when people ask me, for example, about this current administration, am I excited about the new laws and everything? I'm like, actually, it's not the laws. It's the fact that the air feels safe to use the technology.
Safer
so it's
out there. Yes.
Almost like it's the fact that our clients are no longer, as scared of actually using the technology. Because again, I think that when you think about these large institutional players, and that's why I said privacy to us was very important, is there are still going to be ways how they, work. They would still care about their fiduciary duties to their clients. They are still going to care about not exposing their client information. They still want to have the right controls. All of those things matter. So for us, it was very important to build those things ahead of time. But I think that the most important thing that we're seeing today, it's not that they're saying like, oh, now we have regulatory clarity. It's we actually feel that the regulators are encouraging us to innovate. So they're not as scared of moving forward.
Okay.
That's honestly amazing. In fact, we're going to just take a little bit more time on the show since we have an incredible cast here today. There was big news about, of course, INX being acquired up to 60 million by Republic potentially. If anyone has any comments, feel free to jump in. But I actually really want to talk about the DTCC news that they announced, actually, that they are launching their own new app chain-based model for tokenized collateral management. So DTCC being, a huge mover, almost critical infrastructure, as we would call it. I would love to go around the room and just get everybody's thoughts on, is this fluff? Is this classic sort of, we're trying to be on the nose, but this is going to move very, very, very slow. Obviously this is sort of potentially a competitor to Canton. So I'd love to kind of hear your thoughts on this, Yuval. But this is, to me, big news. It's worth talking. I'd love to get everybody's thoughts.
They want to stay relevant, no?
Of course they want to stay relevant. We've been seeing them do that for several years,
But isn't this the PR release in a few weeks again? Every few weeks they release something with blockchain.
I think we know the camp that Nico's in. Sharon, any thoughts on this one? Phillip?
I'm sorry.
Any thoughts on the DTCC news about their new tokenized collateral management platform?
You know, in the spirit of full disclosure, I am not as up to date on it and don't know all the details. So I don't want to give people, some sort of wacky answer just to give a wacky answer. So I'm not the right guy for that.
So
Well,
we're going to do some digging to maybe hopeful.
They're launching a live event called the Great Collateral Experiment on April 23rd.
Yeah, that's what I was going to say. They're like calling it an experiment. It's not something that even, we know kind of what's going on there. So,
Yuval, come on, what you got? Don't hold back.
No, I'm gonna be very positive about it. So listen, I mean, at the end of the day, you said they're trying to stay relevant. I think that people, especially in crypto, always underappreciate what does it mean to manage, tens of trillions of dollars of assets, and also they underappreciate how much governments are not going to give up CSDs. They look at CSDs, central security deposits, as a national asset. It's national infrastructure. So I sometimes think that people think, oh, look, the DTCC is so sleepy and slow. Eventually, someone would get rid of them. I don't think that that's happening. Definitely not anytime soon. Yeah. The reality, though, and this is where I get excited, is that I do think that collateral mobility is the killer opportunity for public chains. We don't even appreciate the numbers of the capital and the revenue missed from collateral not being able to move globally 24/7. I mean, if you think about what stablecoins did to crypto, again, for everyone, we've been in crypto roughly from 2012-13. My co-founder actually created Cumberland for DRW. I used to be a market maker at DRW. And, in the early days before Tether, you had to over-collateralize all of your crypto exchanges because you couldn't send fiat fast enough to capture opportunities. So if you wanted to have, as DRW, $10 million kind of trading room on every set exchange, and let's say there were 5 legitimate exchanges, you had to deploy $50 million to have like a $10 million credit line. And then Tether came and said, no, actually, we can mobilize your fiat 24/7 everywhere in the world. And suddenly you could have gone from, let's say, 50 down to like, let's say, $15 million to have a bit of cushion in every location. But technically speaking, you could have gotten your $10 million anywhere you wanted in real time 24/7. Think about what that did to crypto, stablecoins, the ability to move cash across all exchanges 24/7, do risk on, risk off, real time. Now, just imagine that for TradFi markets. I mean, just to put in perspective, crypto is a drop in the bucket. I mean, I mentioned just one of our clients tokenized over $2 trillion of treasuries and are doing $100 billion a day of repo. And that is still small, and that's just one thing. So I think if you kind of just take a step back and you think about what stablecoins did to crypto, and now imagine you could drive the same kind of energy into TradFi markets, we're talking of, billions, if not tens of billions of dollars of actual P&L every year as a result of that. So, I don't have necessarily all the details on what DTCC is doing, but I just say, like, if you just take a step back, I wouldn't discount those things. And I would also have an appreciation for how big that opportunity is.
I too support this experiment, as they call it. I hope to see it actually take some life and bring, like you guys are, a lot of assets on chain at the end of the day. That is what this great movement is all about. Unfortunately, that is all the time we have now. What an incredible cast. Kyle, I got to say, I think I kind of liked having 6 people up in the room today. Thank you, Yuval, Phillip, Sharon, Nico, for coming on the show this week.
Thank you.
Thank you.
Thank you.
What's up, everybody? At this point, you should all know about the RWA Foundation, our initiative to bring the industry together in a crypto-native way. And of course, we've been teasing our Wally DAO, which we have our white paper live on our website, rwaf.xyz. If you want to go learn more, or better yet, go tap into our community on X or on Telegram, where we are building the largest crypto-native community of RWA investors, enthusiasts, partners, and everything else. And we've been, teasing a lot. We put out a goal of a TGE in Q1. It is unfortunately no longer Q1, but we don't aim to be too far behind, folks. We've been teasing a lot of launch materials, a lot of potential announcements. And I mentioned that we finally have a chain partner that we'll be launching on. We have some credible partners beyond that involved that I cannot wait to announce. All you can do is show up to tokenize this. That's all I'm going to say. All right. It's going to be well worth it to show up, because this is not live streamed. And that's all I'm going to say for now. So make sure you check out the RWA Foundation. If you love Wally, you love the Wally DAO, please come join us in New York City for a heck of a lot of fun and a very, very big announcement. With that, let's get on with the show.
Welcome, everyone, back. Security Token Show interviews, as always. And this week, we have Ed Nwokedi, founder and CEO of RedSwan CRE. How are you, Ed?
Doing great, Jason. How are you today?
Doing well. And even better now that you're on the show. We have some exciting stuff that came out from you guys recently, which was that you guys have your own real estate tokenization report that came out recently, covering various aspects of the asset class. Really, we're talking about family offices, asset managers, investors, and how they're being impacted. We're talking about the assets themselves and growth projections, because tokenization, as we all know, is really entering the space hard now, with institutions jumping in and understanding the power of this technology. There are people in the space that have been around for years, including us, and of course RedSwan here. So Ed, give us some highlights of the report, just real quick, just things that people should look out for, and then we can dive into some of the more deep conversation around it.
Absolutely. I think the report is really just to kind of sound the alarm, to let major real estate investment companies know that a change is taking place with technology and tokenization, and how it's going to impact them in their business. I mean, directly impact them. Just a starting point with $4 trillion emerging over the next 5 years of real estate going on chain has a very powerful effect on all the major food groups that are touching that real estate, whether it be commercial real estate service providers like Cushman & Wakefield, JLL, or private REITs that are growing their asset base and looking for more investors to come on board. So we wanted to make sure that the industry hears it, understands it, because some people are still looking at security tokens being more crypto related and not something that they should focus on. But this is a direct impact to capital markets, and therefore we wanted to break it down by vertical, because you're talking about hundreds of billions of dollars, if not trillions of dollars, in verticals that will be affected. And when you start talking about those kind of numbers, and you see the players who are the leaders in that, something is going to change with regards to the leaderboard in those verticals. And it's going to be those who adopt quickly would actually make that change. And we've seen that through various types of technology developments over time, whether it be the internet coming on board, and you had to start looking towards having commercial business on the internet, or you looked at taxis being affected by Uber, you look at Polaroid camera or Kodak being affected by digital. If you're not paying attention, you can be left behind very quickly. And I think this is the purpose of this report was to let them know not only how it's happening, what's happening within it, and what industries and also what countries are adapting to it very quickly. So it was a really in-depth report, about 65 pages, and it was really meant to make sure people can see themselves in that report.
It's definitely an in-depth one, everyone watching, and we're going to have the link in the description, so make sure you check it out. Ed, you mentioned an interesting number there, 4 trillion. In the report itself, it says that RedSwan's prediction is 3 to 5 trillion, right, in market value coming on chain for the real estate sector. STM, as anyone remembers, we also have our real estate report, and more But really what the thing here is our prediction report, where we thought it was 6 to 8 trillion. So I know in the graph here, that one of the graphs on the report, it says that ours was used as the baseline. So I was just curious what the math was and how RedSwan came to the $3 to $5 trillion range there.
Yeah, good point. I mean, you're a little higher than us, and I like your number because I like more than less. But we looked at, the overall consensus of assets going on chain, investment assets, roughly $16 trillion. And, real estate is roughly between 25 and 30% of most investments across the board. And so we can kind of figure out that real estate is in that size and being a more conservative level. And that's kind of how we came up with that. Then we looked at the various verticals to determine how much they're touching with real estate and how often they're churning that real estate to determine, how they're going to be directly impacted.
Makes sense, right? And it's very hard, by the way, anyone watching, it's really hard. We've seen prediction reports all over the place from top consulting firms, from other, banks, asset managers, et cetera. But really the idea here is everyone has a different approach, and it's really understanding what's possible here because, the DMV over in California had, put a lot of the car titles on chain, millions of them. What's to stop them from now doing the same thing with now title, right? And that's a bunch of real estate coming on chain, not to mention other forms of it, whether it's funds or equity, stuff like that, and really making this possible to grow.
Bottom line, though, Jason, these are both big numbers, whether it be 6 billion or 3 trillion.
Either way, it's a lot.
Yeah, a huge number and huge impact in the industry for sure.
So let's talk more about that impact. You guys cover a couple other sections, but it was interesting to see family offices, asset managers, and of course, the individual investors are also covered here. But what would you say is the biggest impact for each of these segments? And I'm sure that each of them gets affected slightly differently, just depending on their goals and needs. But Ed, please, let's dive in.
Yeah, I think it's the REITs, the private REITs, that are going to be mostly heavily affected because you're looking at over a couple $1 trillion in that sector alone. And those who lean towards tokenization will now be able to offer direct liquidity to their assets, which is a big change from the current system where they have redemption process. And if you look at the pain points, for example, Starwood, that had the pain points a few quarters ago, meaning that they had customers who wanted their capital return because it was that time to get their liquidity. But Starwood was not able to give the liquidity because they didn't have the cash flow. And also that's at the same time, they were seeing lower values based on higher interest rates. And so they were in a tight situation in which they could not provide liquidity to their customers. Now imagine if Starwood were able to tokenize all those partnerships, the billions, multi-billion-dollar partnerships they have that their investors are now kind of trapped in. These investors would be able to come to their website and actually get liquidity right off their website by allowing kind of a secondary exchange platform to the website. So it just makes a total difference. And if that was the case, that Starwood now is able to provide liquidity to all their customers and they're all happy, think about the other REITs, private REITs that have that same use case problem are going to now, their customers are going to shift and come to Starwood because that's where they want to park their money, where they don't have to be trapped over a long period of time. They have that liquidity. So that gives Starwood a bigger customer base, and the competition a lower customer. So that's just one example of where I see it affecting the private REIT industry. But then you have like the real estate servicing industry, capital markets like Cushman & Wakefield, JLL. I had long-term experience with Cushman & Wakefield as executive director. We did $70 billion a year in terms of capital market transactions, selling whole assets from one party to the next. That was a great lucrative business. And with it came a lot of toll takers who were taking fees along the way. Imagine now that if these $4 trillion of assets go on chain, that's removing $4 trillion of assets out of their ecosystem that they can't sell 100%. And the only way to actually generate, access to both of those markets, the traditional and the new, is to be able to get licensed with the SEC to be able to sell security tokens and now start onboarding new clients and providing tokenization as a service.
Yeah, you're bridging essentially two different worlds, right? You have the traditional assets, the crypto native investors, and vice versa. You also have traditional investors, asset managers are also looking for those benefits of just having the same assets that they're already investing into real estate, but just having it operate on chain. There's a lot to dive into in there. For now, if you're watching it on the Security Token Show, we are going to move on to the next section of the show. But if you're interested in watching the rest of this interview, we will have it available on STM TV Official on YouTube. So go check it out.
Wow, Kyle, so much amazing news, that amazing interview from Calastone, all the great topics we covered with 4 other people on the show. Holy smokes. Like I said,
a crowded episode, and it doesn't stop there, Herwig. We have a full slate of Token Debrief headlines to get through. You want to lead it off?
Yeah, indeed we do. So, again, in the spirit of time here, I'm going to run through them, Kyle, and why don't you go ahead and just, afterwards by section here, just let me know which one you'd like to offer some commentary on. But I want to start off with some major announcements that we haven't yet covered on the show. Archax officially expanding to the U.S. Through Globacap acquisition. Okay, this is a broker-dealer focused on tokenized assets. So naturally a good fit here. Archax is the leading UK-based tokenization broker-dealer, but now they're making moves into the U.S., expanding likely across Europe. They're building a global presence here, Kyle. Hashsphere is another big announcement. Okay, Hedera by Hashgraph. Hashsphere is on Hedera, but they are launching its own private blockchain, essentially specifically designed for TradFi. Okay, for institutions to use. WisdomTree, they're taking their funds now to more chains. It's now on Ethereum, Arbitrum, Avalanche, Base, and Optimism, all through their WisdomTree Connect app, which is pretty cool. If you haven't checked it out, go download it if you're in the States. Also want to shout out Miami-based Nonco that is tokenizing the FX markets. Okay, this guy's actually a beast if you look into his story with what coming out of OSL. But ultimately, they see an opportunity to take non-USD currencies and turn them into stable coins, because you need to actually tokenize all the FX markets, not just the US dollars. Kyle, any of those announcements strike out to you?
Yeah, well, I think that all of them follow in a similar theme, which is that the bridge between DeFi and traditional finance is getting closer and closer and closer. You've got Archax, the regulated side of this industry, now building a global system so that they can support international transactions working in the United States, obviously the capital markets center of the world. You then have Hedera building their own middle layer kind of blockchain solution to connect that stuff. And then, of course, on the non-co side, building in all the different types of assets that are going to need to happen in this market. I think the general theme here is that we are making steady progress towards actually bringing these worlds together once and for all. That is a fascinating update from where we were 5 years ago, where it was all about disrupting and having a parallel universe. Now we've kind of accepted that reality, and now it's about bridging the two together. I think that all these companies are solving that problem in a different way, which is desperately needed for market adoption.
When markets come on chain, you need to connect them globally. Obviously, we're going to see them on multiple chains, as we see here with WisdomTree, and as we see yet another one launch once again, and even FX markets getting brought on chain. Love. But there's actually some new official offerings too, Kyle. So Capital Trust Group, they're launching a $50 billion agritech bond, okay, for the continent, I believe, focusing across Africa. On agriculture technology, 50 billion. I sure hope they can fill that. That would be awesome to see. It goes to show you how bonds can really scale in the token world. BitShop, they're launching their own 1 million, or their own bond, but it looks like it's done over 1 million already in volume on day one. So congrats to BitShop there. Again, proving out bond tokenization. El Salvador, there's a local real estate group. They're tokenizing 10 different warehouses.
Wow.
Worth about $20 million, Kyle. And then Sumitomo Mitsui, they're launching a stable coin on Avalanche via SMBC next year. And finally, Serenity and MTA, they say that they are going to tokenize real estate together, but focusing around crypto natives. So presumably maybe in the Middle East, maybe globally. But any commentary, Kyle, on any of these token offerings?
Well, I actually think that this is an interesting kind of result of a growing stablecoin pie. So as the market cap of stablecoins increase, the demand for tokenized debt products will also increase, because debt is the best way to get a return on your fiat or dollar pegged capital. So by that reason, I think it's fair to expect that we will continue to see more real estate debt offerings and corporate debt offerings as the stablecoin supply increases. And I think that this is a good example of the different types of use cases that we might see as this industry grows.
You love to see it. You love to see it, especially that $50 billion bond. Love bonds, love real estate, love it all, including tokenized stocks. So if you have some time, you should get to know White Rock. They actually are using NASDAQ's data tied in with Chainlink for their tokenized stocks platform, which has done well over $100 million in volume already. Boostry out of Japan released a report that people can go check out about the state of the Japanese security token market. Larry Fink has once again beat the drum of tokenization, endorsing it in their latest annual letter from BlackRock. Vlad Tenev, CEO of Robinhood, also continues to be talking about the tokenization gospel and continuing to spread it. But there's a new one on the block too. Now the co-CEO of Kraken, Kyle, says that tokenized equities will one day surpass stablecoins in size. And we know that Kraken's new chain, Inc., already supports the Accred product by Apollo. So it seems like we're certainly already seeing Kraken's direction around RWAs. Nice to see leadership excited about it too. Kyle, any comments?
Yeah, I'm gassed about this. They, they have long rumored to be trying to go public. We'll see. Perhaps they are in that process. Maybe they've scrapped it. I don't know. But Circle is set to go public here in the next couple of weeks. Hopefully, maybe that will drive some addition from Kraken. We know that Coinbase has also talked about tokenizing equities. So the exchange arm race might be on with respect to tokenizing securities. Really cool to see that everybody's so bullish on the industry.
I love how you put that, the exchange arms race. That's exactly what we want to see happen for the tokenization market. So I am all for it. Well, maybe one of those pieces of news or something we heard earlier is good enough to win this week's Company of the Week. So Kyle, let's get to it.
So Herwig, what do the Presidential Medal of Freedom, the Nobel Prize for Economics, and the Company of the Year award have in common?
Whew, you tell me, Kyle.
They are the most prestigious awards you could possibly win in terms of the developments, innovations, and fantastic accomplishments in the entire world. Okay, I'm obviously being a bit hyperbolistic here, but that doesn't change the fact that we have the Companies of the Week segment to close out an unbelievable episode of the podcast. On this show, we have done for 279 episodes straight, picked two companies that we saw had the biggest impact, were the most noteworthy, or just deserved a special shout out at the end of the week. And in doing that, they actually get nominated to be selected potentially for the Company of the Year award, where we pick one company between the two of us that we thought made the biggest impact in the industry. We've been doing this for 5 or 6 years running now, and we aren't stopping anytime soon. So without further ado, Herwig, I cannot wait to hear who is your Company of the Week winner this week, episode 279.
Yeah, congrats to BlackRock, last year's Company of the Year, and congrats to all the Company of the Week winners. It is indeed a very prestigious award, and I'm excited to give it this week to DTCC. Now, I know you were listening earlier, and hold on, I know I was giving them some shit, but I also heard Yuval, and I also agree. You know, the DTCC settles quadrillions in securities a year around the world. This is not something that moves overnight into a new direction. And it's exciting to see them continuing to push activity in this market. As we like to say, they want to stay relevant, but it's not just about relevancy, right? At the end of the day, we all know this is where the market is going to head. And the fact that they are already exploring collateral mobility, which many of us, including myself, agree it is the killer use case. It is what's going to lead to a huge boost in adoption for tokenized assets and in tokenization in general. So I support this tremendously, and I hope it succeeds, as they call it, an experiment. But because they announced it, because they're going public with it, DTCC, you're my company of the week.
I think that's a great winner. They have been steadfast in their tokenization dedication, if you will. They acquired Securrency. They've been in this space for a long time, really trying to understand where to fit in. They've launched a sandbox environment as well on top of everything else they're doing. I think DTCC is a great choice.
Absolutely. But Kyle, I'm not the only one who gets a choice every week. So do you. So tell me, who did you pick this week?
Herwig, here's the deal. I am a biased interpreter, right? When I look at the landscape, we've talked about this on the show before. I do tend to like to highlight companies that maybe are making a new stride in innovation. I definitely like to highlight fundraisers that have been successful, specifically over the last couple of years, just due to how hard that environment has been. But I also do have a soft spot for Miami-based startups. We are both based in Miami. I've been in Miami for 10 years now, and I'm so happy here. I love to support the local tech environment. So for that reason, amongst many more I'm about to dive into, my company of the week is Miami-based Nonco. Nonco is building and scaling the stablecoin market, specifically targeting different fiat currencies outside of the dollar and making sure that they're interoperable within the Forex marketplace on chain. This guy is a total beast. The CEO of Nonco, Fernando Martinez, he's been in the space for a while. He was at the crypto exchange OSL based out of Hong Kong, and they seem to have a really clear vision on the disintermediation of the SWIFT network, something I've been working really, really hard on with global settlement. And I think that there's a ton of opportunities that I can work with him. I think STM would love to see the success of this type of business, and the industry as a whole needs more stablecoin solutions to connect into the broader ecosystem. So for all of those reasons, want to shout out Nonco for crushing it and supporting Miami.
I think that's an absolutely awesome choice because it's an incredible company that also happens to be located in Miami. I love that fact too. Crypto capital of the world, tokenization capital of the world. Maybe I think we're fighting for it with New York, but as you know, Ken Griffin likes to say, Wall Street South. It's being built right here, and Wall Street's going on chain, everybody. So don't forget, tokenize this. We're bringing it right to Wall Street, right in New York, just a few weeks away. So get your ticket, folks. Get your ticket. Make sure you register. We'd love to see you in person. Kyle and I will greet you with open arms, a hug if you want one. We're here for you. But go to stm.co in the meantime. We got all the latest news. We appreciate your support. So like, subscribe, share this. It really means the world to us. And Kyle, and any final closing thoughts on your end?
Hey, look, happy to be here. Can't wait to see people in person. If you want a signed copy of our book, I'll bring some. So definitely find me during the conference so we can give you that. And, it's only 2 weeks away, so make sure you buy your tickets.
Right on, everybody. Well, it's Friday, so I'll let you all get to it to enjoy the weekend. And meanwhile, happy tokenizing.